Cheung, who is the Chief Investment Strategist and also Fund Manager at Galaxy Asset. And Galaxy Asset's Deep Value Fund was one of the 2009's best performing startup funds, more than quadrupling its returns since its inception as of December. Now, the fund was also voted Asia Hedge's new fund of the year. That was 2009. Welcome to the program, Johnson.
Thank you.
So you did very well there. Let me just ask you about 2010. As you said, the HSI is going to hit 25,000. What's going to drive the gains, I guess?
Well, first of all, the economic picture is actually quite positive. We are still very positive on China's economic growth. We expect it to grow by 9.5% this year. At the same time, we are still seeing the government very pro-growth policies in place, such as aggressive credit expansion as well as fiscal stimulus. So these are the positive factors that we see.
Yeah, and what about what we just told you recently, that one brokerage says that you can't rely on consumer spending on the mainland. It's more about the investment boom, and this you have to look for the construction boom to boost up growth in 2010. What do you think of that prediction?
Well, for a more balanced growth, I think China definitely has to stimulate the domestic demand. That is not just the consumer spending, but of course it includes the investment spending and also the infrastructure spending as well. Now, for the consumer spending, though, we are still positive that it will continue to rise at a very fast pace. One of the reasons is that consumer spending is still underrepresented in China's economy. It accounts for less than 40% of the GDP growth. Right, so I think over the next few years, it will continue to outpace the GDP growth.
Okay, well, let me just ask you this, because you said the first half you're going to see gains, but the second half you got to be a little more cautious, more risk at play.
Yes, I think for 2010 we are expecting sustained economic growth, but the pace will be quite uneven. So at the same time, inflation could come in the second half of this year. This will force the government to perhaps further tighten the monetary policy. So I think these risks will definitely loom larger in the second half.
Yeah. Well, do you think they're tightening now at this point? Because as I mentioned earlier with Lorraine Tan and others, that we're seeing investors really concerned about monetary tightening, just with a few blips of the interest rates that we're seeing on these 3-month bills.
I think sentiment is actually quite fickle. But at the end, if you look at what the Central Economic Committee said at the end of last year, I think the government will still actually tend to be pro-growth.
Right. Really? Pro-growth. It is pro-growth, but what about overheating?
There are definitely risks of that. And I think the government policies is for several specific sectors will be definitely on the cautious stance. That includes the real estate sector, for instance.
Okay, so you're not investing in the real estate sector then?
We are not that exposed to the real estate sector. We are more cautious on that.
Okay, well, let's talk about the stock picks then that you are recommending. And it's interesting because we're talking about Hong Kong exchanges and clearing once again. Last year we really didn't talk about this stock, but it seemed like to be the stock of the year in 2008 when we saw volumes just going through the roof. Why do you like this stock in particular? Do you think volumes are going to come back to the extent that we saw in 2008 or 2007 again?
Well, for three things. So first of all, I think the stock exchanges are always very stock market performance driven, and the beta is always 1 to 2 or 1.3 by our own estimates, right? But for Hong Kong market, for this year we see continued capital inflows. Money supply M2 growth will still be very strong, right? So I think it'll be a beneficiary of the ample liquidity out here. At the same time, I think the overall the turnover is still actually quite low, and you should actually pick up. I think Hong Kong Stock Exchange is at the crossroads right now. A lot depends on the new IPOs, and it seems to have demonstrated some success in attracting international companies to list in Hong Kong.
And it's trading at 150 Hong Kong dollars at this point, pretty much where analysts are expecting it to be. But how much upside is expected for Hong Kong exchanges?
Yeah, we expect a 20% upside.
20% upside.
This is based on a higher daily turnover this year. We expect the daily turnover to be about 80 billion Hong Kong dollars per day. And on a 3.5% yield, that would imply a target price of $180.
$180
Yes.
going forward. Okay, let's talk about quickly Guomei, which is an electronics retailer. It used to be the biggest on the mainland. However, it has been surpassed by its arch rival Suning. And there's been a lot of problems with this company, of course, with its founder Huang Wangyu being placed under house arrest for economic crimes in China. But you're saying buy Guomei at this point. Are its problems, its managerial problems in the past?
Well, definitely there will be still continue rumors about this investigations into its ex-chairman's activities. Right? I think that will still affect the stocks in terms of sentiment. But I think if you look at the China consumer space, we have companies trading a fairly lofty valuation, which doesn't actually allow for disappointment operationally or in terms of earnings.
Yeah.
Guomei, to us, is actually a safer and more attractive play because of its valuation.
Right. It's expensive, though, don't you think? 75 times PE is what we're saying on the Bloomberg terminal?
Yes, but earnings are actually going to catch up. I think, first of all, we are still confident in the consumer spending. Secondly, the company is now actually showing margin improvement. So on our own numbers, it's trading at 18 times 2011 earnings.
Okay, so it's 287. Where do you expect it to go quickly?
I think it will actually go up to about 340.
340 or so. Okay.